Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Tuesday, December 10th, 2024. We're coming to you from a beautifully clear and blue Redmond, Washington. A little chilly, though. Great to be with you here every weekday after the close, making sense of these markets, trying to, tease out as many insights as we can by looking at the charts. The way that I pick things for this show, by the way, is basically all day I'm looking at charts for one reason or another. I'm either interviewing someone, I'm being interviewed by someone, I'm writing an article, I'm being asked questions about a particular chart. And anytime I find something that's interesting, I put it on a chart list, which is what the chart review ends up being. And then as we get closer, I kind of review what I've put aside and add a couple things to sort of round it out. And that's what we go with. So it really is reflecting what I hope you get out of it. It reflects my own natural process of analyzing the charts through the course of a normal trading day. I hope that it helps you make sense of things, improve what we call our market awareness as investors, becoming more mindful investors, mindful of our surroundings, and paying attention to the message of the markets. And I also hope that it helps you think about how you approach the markets and reflect on some of the tools and techniques and routines that you can apply in your own process when you're not watching the show to improve your awareness and to make better, more informed decisions in your portfolio, whatever questions you are trying to answer as an investor. With that in mind, let's get to our market recap. As I'm looking at the charts through the course of the day today, things sort of deteriorated after lunch Eastern time, right? So I'm on Pacific time zone. So I usually check in with the markets soon after the open around 10 a.m. Eastern. And then, around lunchtime Eastern is when I'm actually getting my day going pretty good around 9 or 10 a.m. And that's when things really started to rotate lower. And I feel like through the morning here in Seattle, as I'm going further on, every meeting I'm in, I check the chart right after, and we're sort of a little bit further. At the end of the day, it wasn't a huge distribution day. Right, the S&P down about 1/3%, we'll call it, closing around 60.35, but definitely not an update. And so this week so far has been sort of a mean reversion kind of move, right? A bit of distribution here in key areas of the market. For now, not negative enough to trigger the Hindenburg Omen. It did not happen yesterday on the close, as I promised I would look at for you. Not enough new 52-week lows to register the signal, so we'll have to check again today. After the close is in. I hate to think of analyzing the markets like you're writing a book, like you're writing a fictional assessment about it. But tell you what, the story would be really cool if you had a big Hindenburg Omen now in December, setting us up for potential weakness in Q1. I think that would be beautifully poetic. But the market doesn't care what we think would be an interesting story. So let's focus on the evidence we're actually seeing. For what it's worth, the S&P closing around 60.35. That's down 0.3%. NASDAQ Composite, the Dow, all about the same. They all had a very similar look and feel, although the Dow did kind of rally out of a lower open, but all of them sort of rotated lower going into the close. Mid caps and small caps down as well. Speaking of small caps, latest episode of our Market Misbehavior podcast, not quite ready because I just did it a couple hours ago. We'll get the episode edited. It was with T.G. Watkins of Simpler Trading. We talked almost entirely about small caps and why it could be a good environment for small caps, given the interest rate environment, given the fact that they've just lagged, mostly given the fact that some really impressive charts and breakouts have come out of that space. We talked about stocks like Reddit and a bunch of others that have really emerged in strong positions here in Q4. So hopefully we'll have that episode posted later today, maybe tomorrow morning. And I hope you will check that out. The mid-cap S&P 400, for what it's worth, ended up being the worst performer on this front page of major equity indexes. The VIX essentially unchanged from yesterday. It did open, in the morning session was sort of below Monday's close, but by the end, it was very noisy and directionally went about nowhere. So the VIX still in a low volatility range, right around 14. So that tells you no real signs of concern just yet. Looking at the fixed income markets, you can see that the sort of longer end of the curve pushed a bit higher today. The 10-year yield just under 4.25%, slightly higher from Monday. Long bond around 4.4%, 5-year point around 4.1%. So bonds generally sold off today. The Treasury bond ETF we follow, the TLT, was down about 0.5%. The dollar, not much of a change, up slightly. from yesterday's close. Looking at the commodity space, I mean, continuing to see strength here in the commodity world. The gold ETF, GLD, was up 1.33%. Silver and copper were basically flat. Crude oil prices slightly higher from yesterday, but gold really the best performer here out of the major commodities that we track. Cryptocurrencies, boy, continuing to just have plenty of volatility. Bitcoin currently trending a bit higher. It did trade below 95,000 earlier in the day. During the equity trading session, it's actually pushed back to the upside, but just slightly above 97,000. So if you look at the last couple of weeks, the story on Bitcoin has been an attempt to get above 100,000, which it has successfully done. But now it's about sustaining that breakout. And I mentioned that on a lot of different charts. When you have a key level like 600 for Meta, or any of those key resistance levels that a lot of the Magnificent Seven stocks have achieved recently, and then when you finally break out, then it turns into, okay, we've now shown that we can break out. Can we hold it? And that's why I talk about sustainability of an up move. You always want to look for follow through, some sign that there are additional buyers coming in that can propel the price to even further heights. We're not seeing that with cryptocurrencies just yet, right? We're seeing Bitcoin push above 100,000 and then continue to pull back. We're seeing Ether prices push toward 4,000 and then be repelled and pulled lower. Ether very much underperforming Bitcoin here recently. Bitcoin still sort of testing that high. Ether prices seem to be pulling back a little more aggressively for what it's worth, and kind of mixed results outside of those top two coins that we track. Looking, and I should mention, boy, disclosures, GLD, Bitcoin, Ether, those are the three things I think I've just talked about that I do own in some way. All right, looking at the 11 S&P sectors, you can see 3 of the 11 S&P sectors up. So we're having sort of what I would call negative sector breadth. I mean, simple idea every day is just how many of the sectors finished higher. That is not a scientifically meaningful probably indicator. I would not manage a portfolio based on that anecdotal evidence, but sort of a quick assessment of how narrow or how broad an advance or decline really is. Today the S&P, the major averages, finished slightly lower. Communication services was up 1.6%. Consumer staples, one of the more defensive sectors, up 0.5%. Consumer discretionary finishing slightly higher. That's driven in a lot of ways by some of the larger names like Tesla having pretty good runs here recently. But that's it. The rest of the 11 S&P sectors, meaning the other 8, were actually down today. Some of them down a pretty decent clip. Real estate, the worst performer, down 1.6%. Technology down 1.4%. Materials, number 3, down 1%. The breadth, and we talk about breadth because for me, I feel like if you just look at the S&P or the NASDAQ composite or the NASDAQ 100 and analyze that chart and feel that you understand what's happening, I would argue that is so untrue, because what you're understanding is what those indexes are doing. But what's happening is because those indexes are so top heavy, meaning the biggest names have such a big impact, you're really analyzing the trend in the Magnificent Seven and then some other things. You're really not getting a sense of the actual behavior of a lot of individual equities that also comprise those indexes. They're just not big enough to actually register on the chart of the S&P 500. Today, again, about a 2-to-1 ratio of stocks going down versus going up. And the S&P 500, as of this moment, it looks like 69% down, 31% higher. So that's not a great day when 2 out of every 3 stocks actually finished in the red. So that breadth deterioration tells you one of 2 things is happening. Either the major sort of Magnificent Seven mega cap growth stocks are strong, but kind of everything else is struggling, which is scenario number 1. And then this is a temporary kind of stealth correction where a lot of individual stocks are maybe struggling a little more than the S&P and the NASDAQ charts would suggest. But because of the strength of the Magnificent Seven, they're going to hold up okay. That's a possibility. Option 2 going into year end would be there's a lot of distribution that's happening underneath the hood. People are going to the relative safety of the Magnificent Seven stocks. Once that's kind of done and investors realize they actually just want to get completely defensive and get out of those things, that's when things can really deteriorate. So for now, it's unclear as to which of those scenarios is going to play out, which is why, of course, we continue to watch closely things like the Hindenburg Omen, breadth indicators, the chart of the S&P, and just, sort of track those movements. But there's no denying that outside of the Magnificent Seven, outside of the large cap growth, things are not looking as good, I would argue, as the major indexes are suggesting. So for what it's worth. Speaking of the Magnificent Seven and friends, let's look at these leading growth names and how they did. Alphabet having a very strong day, up 5.6% today. That's your best performer out of this group. We did grab that chart to focus on here in a few moments. Not making a new all-time high just yet, but certainly coming out of a consolidation phase and breaking out to the upside. So I think that's the next logical step, is to see if that continues. Tesla closing above $400 a share. That's up almost 3% from yesterday's close. On the downside, Nvidia continuing to struggle along with the other Magnificent Seven. I mean, the chart's not horrible, to be clear, right? We're not too far below all-time highs, but it's not going up on a day like today when others definitely are. This seems like a very negative outlier, down almost 3%, while the average Magnificent Seven stock was in much better shape. Let's go to the market carpet. Just a quick reminder, I appreciate you guys watching on Facebook, on LinkedIn, on YouTube, on X, whichever one you're on if you're watching us live. I can't thank you enough for doing so. Questions that come up during the show, just pop them in whatever platform you're on. Put a comment in with your question. I can see that here real time. And at the end of the show, I'll try to take a question or two before we wrap the live stream. If you're watching this on delay on our YouTube channel, I appreciate you as well. Just drop any questions below there in the comments section. I will grab all of the unanswered questions, put them in the Chart This mailbag. We'll plan an all mailbag episode on Friday where we answer some of the great questions we're receiving here. All right, the market carpet, looking at this heat map style visualization. As you probably know, if you've watched the show before, 3 questions we answer with this. Number 1, what's the overall impression looking at the general contours, the general configuration of the heat map? Number 2, what are the largest names doing because they have such a big impact on our benchmarks? And number 3, what sort of opportunistic outlier kind of ideas look a little different, look a little interesting, things that we might sort of unpack from this. So number 1, I mean, obviously very mixed day, and I'm immediately drawn to the bright red that we're seeing all over the technology sector. I mean, it certainly feels in a lot of ways like a leadership rotation is amiss, where you see a sector like technology, which has been such a dominant sector in so many ways. We've seen weakness in semiconductors. We've been documenting that for a little while, but now you're starting to see kind of a little of everything rotating lower. I mean, looking at the names that are on the downside, plenty of semis represented, like Micron, like Lam Research, like Intel, what else? AMD, Qualcomm. These are all semiconductor names that are rotating lower. But boy, other things like Western Digital, which is a hard drive manufacturer, Hewlett Packard Enterprise, HP Enterprise, down 5%. Some of the renewable energy names like that's monolithic. Enphase is what I meant to say, sort of pulling back. So it's sort of a little of everything. But Oracle and Nvidia and Broadcom, some of those larger names that are down today, that definitely hurts. But boy, semiconductors continue to lag. I was sort of taught, and I forget who probably pounded this into my head, because I feel like very thankful for having some really good mentors along the way at different places. But someone would always tell me to look at semiconductors and follow the trend there. And a couple things always stand out. Semiconductors as being a good bellwether group to pay attention to. The shipping companies like FedEx and UPS, one of the guys I would talk to would always stress that, because that tells you what consumers are buying and getting shipped to them. I get that idea. And so if those are doing well, things are good. Boy, some of my old school mentors would talk about the generals, sort of the idea of looking at the big names. Now, back in the day, those were like General Electric, General Motors, kind of big, conglomerate industrial names. Now it's sort of the Magnificent Seven. Those are sort of the generals of the day, I would say. So let's get to chapter 2 then, talking about the biggest names. Alphabet, up over 5%, certainly stands out to me. Tesla, not much of a surprise, only because it's been doing so well. I mean, it's arguably been the best of the Magnificent Seven here recently in terms of consistency of the advance in Q4, coming off of a low in mid-October. On top of that, kind of mixed results for some of these other ones. Apple, Microsoft, kind of one up, one down. When you're looking at the Magnificent Seven, I keep coming back to Apple making new all-time highs, Tesla making new all-time highs, Amazon, down a bit today, but fresh off of a new all-time high this week. Meta pushing above 600. So, the strength in our benchmarks, I would argue, is driven by these biggest names looking as good as they do. If those charts were not that strong, the S&P and the NASDAQ would be nowhere near the levels that they are now. That's how the math works out. All right, finally, looking at some outlier sort of individual things. What struck me as I was reviewing this earlier, sort of the mixed bag that you see in something like healthcare or industrials. Healthcare probably more negative, but like looking at industrials, you have Boeing, you have Alaska, some of the airlines like American Airlines having decent days. Some of these ones like Honeywell, Union Pacific, having decent up days as well. So I'm finding stocks that are performing quite well in industrials. I would also say consumer staples. I mean, I think the average color is kind of like light green in the consumer staples sector. This is one day, but in this sort of environment where the trend overall is positive and I'm looking for signs of something different, staples starting to do really well would be one of those sort of red flag kind of checks saying, ooh, why are these more defensive, kind of lower volatility, higher income names doing well? Still early days, but I would say keep an eye on the consumer staples sector for sure. All right, let's continue on here looking at the charts. In our chart review segment, we can see the S&P, of course, coming off of a fresh new all-time high 2 days ago, touching 6,100 for the first time. That was Friday of last week. Monday and Tuesday, kind of a distribution week so far. We're closing at the lows of the day. This is very much feeling like distribution. The volume picture, if we look at the chicken money flow, which we did yesterday, I don't think I grabbed that for today as well. Chicken money flow is kind of net negative here this week. So you're seeing, sort of those signs of distribution. Some of the breadth indicators that we follow are coming out of extreme regions, which often indicates or suggests a significant top of some sort. No change in my general thinking on the S&P 500. I think the trend is up until proven otherwise, or as I like to say, innocent until proven guilty. I would say S&P over 5850. I'm happy kind of thinking of that as noise. Anything below 5850, that's something where you have to sharpen your pencils and sort of reevaluate your life as a raging bull here. Overall, I mean, I still have plenty of exposure to stocks. I'm generally assuming that trend's going to continue until the chart tells me that it's not going to continue. That's actually a really interesting comment that T.G. Watkins made earlier. And again, I'll hope to get that podcast episode out to you later today. He was basically, I asked him toward the end, with some of the stocks that had such good runs, like how do you manage risk? How do you make sure you don't give up all those gains if it rotates lower? And he said a number of things, which I'll save for the episode. But, the general takeaway I would say is, watch the chart and use tools that will help you determine with a fair, reasonable expectation that the trend is over. And he talked about some different ways that he tries to do that. But I think that general assessment is spot on. So with the S&P, I think it's going up until it's not anymore. And so I'm not seeing anything telling me it's not going up anymore. I'm seeing further strength for now. Here, boy, that's a busy chart that I didn't intend to include. That's crazy. We'll focus a little, sorry about that. We'll focus on just these two here. I just want to highlight the stocks above their 50-day and the stocks above their, no, this is not the chart that I wanted. Come on, Keller. Hold on a second. We'll go back to this one. This is one of the many ways you can tell that this is live, is I'm making it up as I go, because this is the chart that I really wanted. There we go. Stocks above their 50 and 200-day moving average. Apologies, guys. This was the chart that I was looking to share with you. If you look at this, I think what you have to remember is that there's a difference between short-term breadth and long-term breadth. That makes sense, right? The long-term breadth for me talks about the overall trajectory. What's the primary trend? Are most things above their 200-day moving average? That's my general assessment for, is the breadth positive on that longer term time frame? Because there can be a lot of noise between, the price action getting down to a 200-day moving average. But as long as it's above that, things just aren't getting that bad. And we can see that 69% of S&P members as of today's close could say that they're above their 200-day moving average. Many 200-day moving averages, if not most of those, I don't know this for sure, but I would assume most of those are trending higher, and that's pretty good. So the slope is good, and we're remaining above there. What concerns me is that bottom panel, which says as of today, only 54% remain above their 50-day moving average. The reason why that's noteworthy is because a couple weeks ago, at the end of November, which was just a week and a half ago, really, there are about 70% of the S&P above their 50-day moving average. So just in the month of December, which is a week and a half old, we've got about 17% of the S&P 500 members that are breaking down below their 50-day moving average. That's not necessarily an end of the world kind of signal, but it definitely tells you that even though the S&P and NASDAQ are going up, a lot of stocks are not going up. And as a matter of fact, they're actually failing to hold their 50-day moving average, which is one of those like basic, gut checks. Are we still okay on this chart? We hold the 50-day and I'm just like, oh, okay, it wasn't that bad. We break the 50-day and you have to sort of revisit, okay, hold on, is this something uglier? And so the fact that we're down to that level from 70% is concerning. Now that's down from 82%. So about 30% of the S&P were above their 50-day at the end of September, and now we're below there. So we're seeing distribution that's not being reflected in the major averages. That's why breadth indicators are usually so helpful to watch, because they help you recognize signals that you may not get just from looking at the day-to-day action on the S&P. I think I've beaten that probably enough. All right. The Hindenburg Omen, as of now, I can't say that it's been triggered in terms of that secondary signal. What we would need to see today would be over 2.5% of NYSE listings making a new 52-week low. Yesterday, we were nowhere near that. We're actually less than 1%. So there just weren't enough stocks that were breaking down to that degree, which is one of the metrics that the creator of this indicator, a strategist named Jim Mieka, originally determined based on analysis of a bunch of previous major tops. We've had a series of initial signals in 2024. We haven't had that second confirmation within 1 month, which is, we've got about a week left, a week and a half to get to mid-late December before we could close the door on another example of that. So we'll see if that triggers today. We'll see. There's enough distribution where it could have happened, but not enough confirmation just yet. We'll keep an eye on that and certainly share with all of you here on the show. I was asked by a media outlet earlier today about Ether prices, and so shared a quick insight, which I'll share with you as well. For cryptocurrencies and with most charts, to be honest with you, I often mention big round numbers, and I mean that with absolute sincerity. There's been academic research, actually one of the first academic pieces that I ever saw that was ever really written talking about price action and how the markets were inefficient, right? I mean, back in the day, like in the 70s, 80s, it's the efficient markets hypothesis, right? And there's no information from looking at price action. That was the prevailing sentiment in academia. Investors are all rational. There's no way to predict movements. It's the random walk theory. By now in 2024, thankfully, most of those things have been either in some small or very large way completely refuted with evidence that shows that investors are actually quite irrational. The whole field of behavioral finance has grown to document that and put some statistical and academic rigor behind that sentiment that I feel like many technical analysts took for granted for years and years. Having said that, there was one of the first pieces I have seen that was a legitimate piece talking about irrational decision making. It was talking about clusters of orders around big round numbers, and it literally showed that human beings selecting order levels would often gravitate toward those things. So it's not just a guess or a made up thing that markets hit big round numbers and then turn. It's actually been documented quite heavily. So having said that, I'm never surprised when something like Ether hits a big round number in like 4,000 and pulls back. Now, what's more interesting here is we've been here before, right? In May, we didn't quite get to 4,000. We were kind of a rounding error away from there. Here, of course, in March, we made the high just above there, almost to 4,100. This week, of course, over the last week, we've gotten right back up to 4,100, testing that all-time high and rotating back lower. So the thing is, could Ether prices just, pull back and then resume their uptrend? 100% that is possible. And the reality is, to be honest with you, some may swear otherwise. I don't think so. I think when you initially have a sell-off from a significant resistance level, a brief pullback before the resumption of the uptrend and a brief pullback before multiple legs lower, they always kind of look very similar right at the beginning because you have an initial sort of sharp pullback off of that high. The question is what happens next. And this is where we look at support levels, is where we look to the left on the chart to see if it holds some support. We might look at moving averages to see if those are held. We might look at RSI to see if it holds like a 40 level, which is often a really good sign that it's just a pullback within an uptrend. It's unclear at this point, but I would tell you is 4,000 is a pretty meaningful level. You would assume that based on the fact that we've hit that before. Also, it's a big round number, as I mentioned. So I think you have a couple things suggesting 4,000 is kind of the level. breaking out above there, I would say similar to Bitcoin breaking above 70, 74,000. That tells you there's a lot of further upside potential to be had. Bitcoin is obviously well above its early 2024 highs and now is struggling with a more recent high. Ether still is sort of waiting to break out. So for now, I would say 4,000 is the level. That's where I have an alert. I do own Ether in my own accounts, but overall, I would say we're in pullback mode until proven otherwise. Gold is one which actually also had a significant pullback in early November. This was after making a high the last week in October. Pulled back, and the GLD pulled back to around 236 or so before bouncing back higher to 250. One of the things we noted in the month of November was how the momentum, if you look at the RSI, we often have talked about how in a bullish market, the entire range of the RSI will move higher. It's called a range approach or range rules or something like that. I've heard different people call it different things, but that was really popularized by Connie Brown in one of her books. Technical Analysis for the Trading Professional, I think that one's called. A really interesting book that really, I think, nudges your thinking about indicators and how to use them. And Connie's done a lot of work along those lines. And that was the first time I had read about moving the range of the RSI up and down, depending on whether we're in a bullish or bearish phase. And then I've sort of reversed that and said, all right, well, if the RSI is in the bullish range and then it quits being in the bullish range, that probably tells me something's different. It tells me there's a change of character. And we saw that in early November when we came off of that high around 258. The GLD broke down, broke below the 50-day moving average, and the RSI broke below 40. Now we're actually seeing the RSI bounce up to 60, and now we're approaching there again. So the way I would think of this in terms of an actionable level, the GLD over 250 with the RSI pushing above 60, that would be kind of the ideal entry point bullish kind of breakout signal, telling you we've consolidated and now are maybe reinitiating a bullish uptrend. So, short term, maybe we've seen that pullback. We appear to be putting in a bit of a higher low, but I'd like to see a break above 250 on stronger momentum to sort of confirm that bullish thesis. And again, I do own a GLD in accounts I manage. All right. Finishing off looking at some individual names, and I'll take a question or two, and we'll be all done for the day. Looking at Alphabet, biggest gainer in the Magnificent Seven list today, up about 5.5% today. Obviously, one of the biggest names in the U.S. and a huge weight in the S&P and the NASDAQ, and especially the XLC, the Communication Services ETF. This gap above 180 is pretty important, and similar, I would say, to charts that we've talked about, like Apple and Meta and others that have had resistance levels that are now broken. You always treat that breakout level as a support. Think of it as like a pivot point. So the way that I would actually analyze this chart right about now is draw this kind of line right here and say, great, this was our resistance. Now we've gapped above there. This becomes my new support. Maybe if I take a trade today on the gap higher, that's my stop, or however you might want to think of it. I'm not sure how you would approach this in your own portfolio, but that's kind of the general thinking, is using the previous resistance level as a new level of support. As long as we hold, those gains and remain above that resistance, then things are in pretty good shape. If we would pull back and fail to hold that level for Alphabet, that's where I would question a bullish position. Because once you have a gap, it's all about the next day, right? So Tuesday was a big gap higher. We've made a new 3-month high. What happens tomorrow? Do you see additional buyers coming in, pushing us back to those all-time highs around 190, 191? Or do we see sellers come in and make some sort of bearish candle, like a bearish engulfing pattern or a dark cloud cover candle? So tomorrow, I think some of those questions will be answered. But for now, pretty encouraging breakout. Nvidia coming off today. This is the worst performer in the Magnificent Seven, down almost 3% today, still above this red line in the sand. A chart like this is sort of range bound. It sort of looks like a rectangle on the chart. These are in some ways some of the easiest charts I would argue you can ever see, because one of two things is going to happen probably pretty soon. Either we break below 132, we undercut that red line. This is a new distribution sign and most likely lower lows coming. Or we rotate higher, we break above 150, resolve that pattern to the upside. We show that buyers are willing to pay even more, and that most likely means further momentum to the upside. So setting an alert right now, which I did yesterday after the show, Nvidia above 150, Nvidia below 132, I would set sort of a binary alert, see which one triggers first. That's the one I would probably follow. Boy, Oracle yesterday telling that it opened higher and then closed lower, right? We often talk about a gap and what happens like right after that. And so the stock gapping higher, opening above 195, but then closing back within the previous day's range, within Friday's range, was not a good look. Today, gapping even further. Now, you did see some buying coming in. So, some opportunistic buyers being excited about, buying Oracle at a steep discount from yesterday's price. However, the gap happened. So again, I would look to see tomorrow what sort of follow through. Can we regain the 50-day moving average? I think that would be pretty important. Now, the problem with Oracle is the problem I see with a number of charts, which is they have bearish divergences going into today, right? I'm noting here the lower momentum readings in November and December. Each one of those new highs came on weaker momentum. You saw the same thing in September and October. You saw the same thing in June and July, where the price did not make a new high, but the momentum slopes downwards. Those sort of patterns of further price appreciation on weaker momentum, usually it's sort of like a stock moving higher on weaker volume. You should just be skeptical, I would argue, of the sustainability of that move. It often happens at the end of the trend. Kind of a similar look here in some ways on Caterpillar, October into November. New high touching 420, weaker momentum. Now, all of course, we've pulled back a little bit. Once again, slightly undercutting the 50-day moving average. Now, what happened on these last couple pullbacks was the RSI did not get below 40. And that's what I look for in this sort of pullback. How do you differentiate a buyable dip versus the beginning of something bad? I would say you watch momentum to see if it can hold a key support level. For now, it's okay. But if we see a further sell-off and we undercut an RSI 40, that could mean further deterioration. Then we get to more this kind of move. We're in a bit of a distribution phase, and it lasts a little bit further than you probably want. Norwegian Cruise Lines, same issue. Higher highs in price, lower peaks of momentum. Cruise lines have been in fuego recently. Really strong move off of the August low. I'm concerned, even though the trend is still positive, we keep making higher highs and higher lows. That's all good. But I'm seeing weaker momentum, a divergence that tells me we may be near the later stages. So, general observations here, as you can see from the charts, breadth conditions getting a little less optimistic. Things like the bullish percent index and others coming out of their euphoric levels. Stocks breaking their 50-day moving average, divergences proliferating. These are things we will often see at a major top. But then, in my opinion, what you then do is look for confirmation, look for signs that the market, as measured by the benchmarks, is continuing to go lower. Not seeing enough of that yet. All right, let's look at a couple. Questions here. Dwight asking on YouTube. Hi, Dave. Excluding tax consequences, what is the advantage of dividends since the dollar gain of the dividend is exactly matched with the dollar loss on the X date? You're 100% right, Dwight, in terms of the reality of dividend investing, and a lot of people really don't understand this. And I don't blame you, right? Let's look at something like, AT&T is a good example because it has a pretty strong dividend, right? So here's the performance of AT&T. And if you look at a weekly chart, you can really see the business from mid-June, July of last year to where we're at now, just this nice consistent uptrend. Here is what happens when you take the dividend adjustments out of there. So on stock charts, and depending on what charting platform you look at, it may be adjusting the data, which is the default look for stock charts. What that means is when a company reports dividends, literally what happens is the amount of the dividend is deducted from the stock price. And so the price sort of has this gap lower and the dividend is paid out. So you're made whole because you, instead of having the money remain as part of the share price, they're taking some of the share price out and giving it to you in the form of a one-time payout or a regular dividend payment. And thanks for excluding the tax consequence. That's a whole other thing that I certainly don't ever want to get into with people. So certainly do your due diligence along those ways, the implications of dividend income. Having said that, right, if you're looking at AT&T over time, you want to understand what the performance is. You probably want to adjust for the dividends because this really tells you what the performance has been, taking that sort of structural change off of the picture. And if you're looking at an indicator like RSI or something like that, you're looking at relative performance of one stock versus another or one stock versus a benchmark. I would argue you absolutely want to include dividends and use what are called adjusted prices. But this is what AT&T actually looked like. So you can see we're actually well below the highs from 2019 on an unadjusted basis because every time AT&T has been going higher, it gets pulled back a little bit for the dividend. So there are two ways to answer your question that you can think of it. Number one, you include the dividends in the price. You sort of adjust for the dividends, meaning you're analyzing price trends based on the pure investor psychology, investor behavior, supply and demand kind of thing. And you're also doing a better representation of what your experience is owning that stock over a period of time. Or you look at unadjusted data, which is what I'm showing here. You have to deal with the fact that you might have these random gaps every time a stock pays a dividend, and it'll basically be a gap lower in the price. I don't know which of these exactly are dividends. I'm not going to put them on, but you'll get a little down, like a little gap to the downside every time there's a dividend because of that adjustment. And you just remember that part of your experience owning this stock is that dividend. I mean, boy, read books about Warren Buffett, and you will see the argument for why. I mean, he was always big on companies not paying dividends and just reinvesting that money into growing the company and benefiting the shareholders that way. There's a whole other school of thought with a lot of investors relying on dividend income as a regular sort of payout and essentially paying out part of the success of the company in the form of an income component. I don't know if there's a right or wrong answer, but I would say those are a couple of ways that I would think about it from a technical perspective. Let's see one other. Let's see. Would you please cover DJI? I'm wondering if you mean the Dow Jones Industrials. That's what I would guess you would do. So I'm going to assume that that's what you meant. I apologize if not. So let's look at the Dow Industrials. Here we go. I was going to say I have a chart list with all the major indexes that I like to track. This is the one we'll look at. You know, so honestly, when you're looking at the Dow, when you're looking at the S&P, when you're looking at the NASDAQ, generally speaking, they are all very, very similar. The Dow is probably, as funny as it is, the Dow is probably the more diverse just because it's price weighted and it has things like Goldman Sachs and others that are not, members of these or not as big of a weight as they would be elsewhere, right? So here are the current holdings in the Dow, and this is the Dow ETF, the diamonds that I'm using just as a quick proxy to look for weights. Goldman Sachs is the biggest bet you're making if you own the DIA right now, right? Because it's 8.2%. United Health Group, 7.7%. So you have to get to the third holding to get to any of the FANG sectors. Compare that to something like the SPY. Here we go. We look at the biggest holdings there. It's technology, consumer discretionary, communication services, consumer discretionary, communication services. Those top names are what? 14, 21, 25, 28, 32% of the benchmark are all just FANG sectors. And it's probably more beyond there. So what you have to remember is the Dow is going to be a better representation of kind of the other stuff like financials, like industrials. And even though there aren't a lot of them included, they're just a bigger weight than they would be in other places. So the Dow Industrials is not a great representation of the market because it's not a big group of stocks and it really doesn't include a lot of things that are important. But it's really helpful, I would say, in 2024 to look at the S&P and the NASDAQ, which are very growthy, and compare that to the Dow Industrials, to the Russell 2000, to the equal weighted S&P, all which sort of minimize that overweight in the growth sectors. Having said that, the Dow is in a primary uptrend. It's doing quite well. It's making a pattern of higher highs and higher lows. We're pulling back from 45K for now. As long as we continue that pattern of higher highs and higher lows, I think we're good. Line in the sand on the S&P, the sort of similar line in the sand for the Dow would be there around 43,000. I think as long as we hold that, conditions are good. If we do see a rotation in leadership away from mega cap growth, don't be surprised if things like the Dow Industrials, things like the Russell 2000 start to outperform in a pretty meaningful way, because that's where you see some of those bigger weights. Folks, I want to thank you so much for joining me here on the live stream or the replay, anywhere you're at. I appreciate you. Thanks so much for following me and my work. We will have the latest episode of our Market Misbehavior podcast posted very soon with T.G. Watkins of Simpler Trading, a lot of other great episodes recently as well. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night.